Three people start the same year with the exact same $30,000. John, age 35, opens a day trading account. Carla, also 35, decides she'll swing trade instead. Maya, same age, same 30,000, buys one index fund and walks away. All three think they picked the smarter path. All three are about to find out that the strategy on the label is not the thing that decides who wins. Because by the time we run this forward 10 years, the gap between them is not a few $1,000s. It is a different life. And the reason for that gap is hidden math that almost nobody calculates. Most people pick a trading style based on a feeling. They pick based on a YouTube thumbnail, or a friend's screenshot, or how much excitement they want. Today we do the boring thing instead. We run the numbers on all three. No hype, no shame, no hustle culture, just the math behind the decision you might make. Here is why this matters more than it looks. The choice between day trading, swing trading, and index investing is usually framed as a question about returns. Which one makes the most money? But that is the wrong question, and asking it is exactly how people lose. The real question has three parts that no thumbnail mentions. How often do you trade? How much tax does that frequency cost you? And what is your time actually worth per hour? Those three hidden variables decide the outcome far more than your stock picks ever will. A study of everyday trader in Taiwan found that over 80% lost money, and only about 1% earned reliable profits over time. A separate study followed 1,600 day traders for more than a year. Only 3% made a profit at all. Meanwhile, the boring index fund returned roughly 10% a year for decades with no skill required. So the spread here is enormous, and it runs in the opposite direction from what most beginners expect. The flashiest strategy has the worst odds. The laziest strategy has the best base rate. That should bother you, and by the end, it will make complete sense. Let's keep this fair. We give all three the same starting money, the same decade, the same accounting. So let's meet our three people properly, because the details matter. John is 35. He works a full-time job, but he's convinced he can beat the market with effort. He funds a margin account because today trade stocks he is legally required to keep $25,000 in equity. That's the pattern day trader rule, and it exists for a reason we'll get to. John starts with $30,000, which clears the bar with a little room. He plans to trade most days in and out, capturing small moves. Carla is also 35, also starting with $30,000. But Carla doesn't want to stare at a screen all day. She chooses swing trading, holding positions for several days or a couple of weeks at a time. Because she places fewer than 4-day trades in any 5-day window, she avoids the $25,000 minimum. She can run her $30,000 however she likes. She'll spend maybe 30 minutes to 2 hours each day reviewing charts and managing trades. Maya is 35 too, with the same $30,000. Maya does something that sounds almost insultingly simple. She buys a low-cost S&P 500 index fund, sets up automatic investing, then she goes and lives her life. She checks it maybe twice a year. Her time commitment, rounded honestly, is close to 0 hours per week. Same age, same starting capital, same 10-year horizon. The only thing that differs is how often each of them touches the money and what that touching costs. Now here's the first uncomfortable fact. John, the most active, has to clear the highest bar just to play. He needs $25,000 locked up. He needs to be at the screen during market hours. And he can't really hold a normal 9 to 5 and day trade properly at the same time. Carla's commitment is lighter, but it's still real. 30 minutes to 2 hours a day, every trading day, adds up to hundreds of hours a year. Maya's commitment is the punchline of the whole video, almost nothing. And yet, as we'll see, near nothing is what wins. Before we run the 10-year math, remember the rule of this channel. We compare like with like. Same money in, same calendar. We count the taxes, we count the fees, and we count the hours, because your hours are not free, even when no broker bills you for them. Let's start with the survival numbers, because they reframe everything. When people imagine day trading, they imagine the winner, the screenshot, the green candles, the freedom. But the data is brutal and consistent across countries. In that Taiwanese study of an entire market, more than 80% of day traders lost money. Only the top 1% earned reliable, persistent profits. In Brazil, of 1,600 traders tracked for over a year, just 3% turned any profit at all. A FINRA report found that 72% of day traders ended the year in the red. And here's the part that hurts. Roughly 80% of all day traders quit within 2 years. So when John funds his account, the honest base rate says he is far more likely to be in the 80% than the 1%. Not because he's dumb, because the activity itself is a coin flip with a fee on every flip. Let's not stay abstract. Let's walk John through a realistic first 2 years, the way it actually tends to go. He starts hot. In month 1, he catches a couple of good moves. And his 30,000 climbs to 33,000. He feels unstoppable. This is the most dangerous moment because now he believes it was skill. In month 3, a position moves against him overnight and he holds it hoping. That single loss costs him $4,000. He's back to 29,000, below where he started. To make it back, he trades bigger. Bigger size means bigger swings, and bigger swings mean bigger mistakes. By month 8, he's at 24,000, and now there's a second problem. He's dipped under the 25,000 pattern day trader minimum. His broker restricts his account until he tops it back up. Think about what that means. The rule forces him to add money. At the exact moment, the math is screaming at him to stop. By the end of year 1, John is sitting around $22,000. He has lost roughly a quarter of his capital, and he has spent about 500 hours doing it. He is, statistically, a completely normal day trader. Remember, 72% end the year in the red. John is simply living the base rate. Year 2 is where most of these stories quietly end. Around 80% of day traders quit within 2 years, and John is tempted to be one of them. He's exhausted, he's behind, and the screen that once felt exciting now feels like a job that pays him to lose. Now the part that almost no beginner models, taxes. When you hold a stock for 1 year or less and sell it for a gain, that profit is a short-term capital gain. And short-term gains are taxed as ordinary income at the same rate as your paycheck. For 2026, that means anywhere from 10% up to 37% federally. For a high earner, add the 3.8% net investment income tax, and the top rate hits 40.8%. Read that again. A day trader in the top bracket can lose over 40 cents of every profitable dollar to taxes. John trades constantly, so every single gain he books is short-term. He never holds long enough to qualify for anything better. Now look at Maya. When she finally sells her index fund after 10 years, her gain is long-term. Because she held for more than a year, long-term capital gains are taxed at 0, 15, or 20%. For most middle-income investors, that's 15%. So John pays up to 40.8% on his wins, and Maya pays 15% on hers. Same dollar of profit, more than double the tax. That is not a small detail. That is a structural penalty for trading often, baked directly into the tax code. People focus on the big losses, but the small leaks are what bleed a trading account dry. Every time John buys and sells, he pays the spread, the tiny gap, between the price to buy and the price to sell, on a liquid stock that might be a few cents a share, which sounds like nothing. But John trades often, sometimes dozens of times a day. Say he makes 400 round-trip trades in a year. Even at a modest cost of $10 per round trip in spread and slippage, that's $4,000 a year leaking out before he's made a single dollar of profit. $4,000 on a $30,000 account is more than 13%. Think about that. John has to earn more than 13% just to break even against his own trading costs. Maya, by contrast, buys once and pays one spread. Her leak is essentially a rounding error. This is the part that never shows up in the highlight reel. The screenshots show the winning trade. They never show the $4,000 of friction that the winning trade had to overcome first. In trading, you are not just betting against the market. You are betting against your own transaction costs, and those costs never take a day off. Here's the principle underneath all of this. Every time you trade, 3 things happen. You pay a spread or a fee. You potentially trigger a short-term tax event, and you give yourself one more chance to be wrong. Day trading maximizes all 3. Hundreds of trades a year means hundreds of spreads, hundreds of short-term tax events, and hundreds of chances for emotion to override the plan. Swing trading reduces the count. Maybe a few trades a week instead of a few an hour. Index investing reduces it to almost nothing. Maya might make 1 or 2 transactions a year. So before we even talk about who's a better stock picker, the structure already favors the person who does the least. The market doesn't pay you for effort. It pays you for being right after costs. And costs scale with activity, run the numbers, and frequency is the silent tax that shows up on every line. Carla's swing trading looks like the sensible compromise, and in some ways it is. She trades far less than John, so she pays fewer spreads and faces fewer chances to panic. She keeps her day job. She isn't chained to the screen. But here's the trap most people miss. Carla's holding periods are still measured in days and weeks. That means her gains are still short-term. She still pays ordinary income tax rates on her profits, just like John. So Carla gets some relief on fees and stress, but almost none on taxes. She's in a middle zone where she's working real hours, taking real risk, and handing the IRS the same cut a day trader would. If Carla's strategy doesn't consistently beat the index by enough to cover that tax gap and those hours, she's working for free. Or worse, she's paying to underperform. There's a second trap inside swing trading that John's day trading actually avoids, and it's worth being fair about. Carla holds her positions overnight and over weekends. That means her money is exposed when she has zero control. A company reports bad earnings after the close. A geopolitical headline drops on a Sunday. The market opens Monday, and her position has gapped down 8% before she could touch it. John, for all his problems, is flat at the end of every day. He sleeps with no market risk. Carla sleeps with all of it. So Carla trades the constant grind of day trading for a different danger. The surprise that arrives while she's not looking. Neither is free. John pays with his hours and his taxes. Carla pays with overnight uncertainty and those same short-term rates. And here's the quiet irony. The thing that's supposed to make swing trading easier, holding longer, so you're not glued to the screen, is the exact thing that exposes her to the gaps she can't react to. Every strategy has a bill. The only question is which currency you pay it in. Now, the most humbling number of all, and it applies to everyone, even index investors. There's a long-running study of how average investors actually perform versus the market they're invested in. The gap is staggering. In 2024, the S&P 500 returned about 25%. The average equity investor earned only about 16.5%. That's a gap of more than 8 percentage points in a single year, simply from bad timing. People pulled money out before rallies and put it back after. On $100,000, a buy-and-hold investor finished the year with $125,000. The average investor finished with about $112,000, over $12,000 lost in 1 year, not to the market, but to their own behavior. And this isn't a one-off. The average investor has underperformed the index for 15 years in a row. Here's why this matters for our three people. The more often you touch the money, the more chances you give your worst instincts to take over. John touches it constantly, so his behavior gap is enormous. Carla touches it weekly. Maya barely touches it at all, which is exactly why she captures more of the market's actual return. Doing nothing isn't laziness. Doing nothing is a strategy that protects you from yourself. Now let's talk about the number that changes how you see all of this, your hourly wage. John spends, conservatively, 2 hours a day at the screen during market hours. Over a year of trading days, that's roughly 500 hours, and that's a low estimate. Many day traders spend far more. Carla spends maybe an hour a day on average. Call it 250 hours a year. Maya spends close to 2 hours total for the whole year. Now imagine the best case for John, the rare good year where he actually makes money. Say he nets a gross profit of 15% on his $30,000. That's $4,500 before tax. Knock off short-term taxes at, say, 32%, and he keeps about $3,060. Divide that by 500 hours. John just earned about $6 an hour, below minimum wage in most of the country, and that's his good year. In a losing year, his hourly wage is negative. Meanwhile, Maya, in a typical 10% year, earned $3,000 on her $30,000 for 2 hours of work. Her hourly wage is $1,500 an hour. The same market, the same starting money. A 1,000-fold difference in what each hour was worth. That is the number the screenshots never show you. Here's where the decade really separates them. Maya's money compounds quietly. $30,000 growing at about 10% a year, untouched, becomes roughly $77,000 after 10 years. She didn't add a dollar, she didn't time anything, she just let it sit and let the math work. John's money churns. Even in the rare scenario where he doesn't blow up, his constant short-term taxes and fees skim a chunk off every winning trade, so his money never gets a clean run at compounding. Each gain is taxed before it can grow. Each loss resets the climb. The honest base rate says John's $30,000 is more likely to shrink than grow, and the 80% quit in 2 years statistic tells you how most of these stories actually end. Carla lands in between. She might grow her money modestly, but the short-term taxes and the hundreds of hours mean her real after-everything return rarely catches the index she could have just bought. Compounding rewards patience. Churning punishes it. Over 10 years, that difference isn't linear. It's exponential. Let's be honest about the winners, because they exist. In that Taiwanese study, the top traders weren't lucky. Their past performance predicted their future performance, which means real skill was present. The top 500 traders earned strong daily returns even after fees, so a profitable minority is real. But look closely at who they are. They treat trading as a full-time profession, not a side hustle. They have an edge they can describe in one sentence and defend with data. They risk tiny fractions of their capital per trade. They cut losers without ego. And critically, most of them are not running $30,000 accounts in their spare time. They're operating at a scale and with a discipline that took years to build. The lie isn't that nobody wins. The lie is that the person watching a 30-minute tutorial on their lunch break is going to be one of them. If you genuinely have an edge, you'll know it because you'll be able to measure it. Across hundreds of trades, not feel it after 3. Everyone else is paying tuition to the 1%. Be honest about which side of that table you're sitting on. So when we say the real math, this is what we mean. It's not just the return on the screen. It's the return after taxes, after fees, after the behavior gap, and after you've fairly priced your own time. On every one of those 4 lines, frequency hurts you. Day trading loses on taxes, loses on fees, loses on behavior, and loses catastrophically on hourly wage. Swing trading wins back some fees and some stress, but still loses on taxes and still costs serious hours. Index investing wins on taxes, wins on fees, wins on behavior, and wins overwhelmingly on time. The strategy that requires the least skill and the least effort has the best structure baked in. That is deeply unfair to our instincts, which scream that harder work should pay more. In the market, harder work usually pays less because harder work means more trades, and more trades means more leaks. There's one more accelerant we haven't named, and it's the one that turns a rough patch into a wipeout: leverage. Because John trades on margin, his broker lets him control more than his $30,000 actually buys. On a good day, leverage magnifies his gains, and that's exactly why it's seductive. But leverage is symmetric. It magnifies losses just as hard. A position that moves 5% against an unleveraged account costs 5%. The same move on a 2x margin position costs 10. And if the loss is steep enough, the broker issues a margin call, forcing John to sell at the worst possible moment or deposit more cash on the spot. Carla, holding overnight, can face margin pressure too if she overextends. Maya, who bought her fund outright with no borrowed money, simply cannot get a margin call. Her worst case is that the market falls and she waits. John's worst case is that the market falls and his broker liquidates him before lunch. Leverage doesn't just raise the stakes, it removes your ability to be patient. And patience was the only edge that actually worked. Now stress test all 3 with a single bad year, because every decade has at least one. Say the market drops 20%. Maya watches her balance fall on paper, feels uncomfortable for a few months, and does nothing. Historically, the market has recovered every single one of those drops given enough time. And because she didn't sell, she's still holding every share when it rebounds. Her loss was never locked in. Carla, trading in and out, has to make live decisions in the chaos. Some of her stop losses trigger at the bottom, turning paper dips into real, permanent losses. And John, leveraged and active, is the most exposed of all. A 20% market drop can hit a margin account far harder, and the same panic that grips everyone hits him while he's holding the most risk. The lesson isn't that downturns are rare, they're guaranteed. The lesson is that the person who does the least is the only one who can afford to wait the downturn out. Volatility punishes activity and rewards stillness. So let's stand all 3 at the finish line and read the scoreboard honestly. Maya, who did almost nothing, turned her $30,000 into roughly $77,000. When she sells, she pays 15% long-term tax on the gain and keeps the lion's share. Total hours spent over 10 years, maybe 20. Carla, the swing trader, worked hundreds of hours every year for a decade. If she was good, she maybe grew her $30,000 to $40,000 or $50,000. But short-term taxes shaved off a third of every gain, and her real after-tax, after-hours result trails Maya badly. If she was average, she's near where she started, having paid herself nothing for thousands of hours. And John, the day trader, statistically never made it to year 10 with his account intact. The base rates say he most likely quit in year 2, down several $1,000s, having spent over 1,000 hours learning an expensive lesson. Same starting money, same 10 years, one of them built real wealth doing almost nothing, and the other 2 paid for the privilege of staying busy. The scoreboard isn't close, and the reason it isn't close is everything we just walked through: taxes, fees, behavior, and the brutal arithmetic of your own time. But here is the twist that flips the whole thing on its head. The index investor doesn't win because index funds are magic. They aren't. The S&P 500 is just a list of companies. Maya wins for a reason that has nothing to do with what she bought, and everything to do with what she didn't do. She didn't trade, she didn't trigger short-term taxes. She didn't pay spreads 400 times a year. She didn't panic sell before a rally. She didn't spend 500 hours earning $6 an hour. Her edge wasn't intelligence. Her edge was restraint. And that means the real lesson isn't day trading versus swing trading versus indexing at all. The real lesson is that activity feels like progress, but in investing, activity is mostly cost. Here is the line worth remembering. You don't get paid for being busy. You get paid for being right, minus taxes, minus fees, minus the hours you'll never get back. The most profitable thing John could do statistically is the one thing his ego won't let him do: less. The hardest skill in investing isn't picking winners. It's sitting still while your money works without you. So which one should you be? That depends on honest answers to 3 questions, not on which strategy sounds exciting. Are you in the 1%? Who can consistently beat the market after taxes and fees? The data says almost certainly not, and there's no shame in that. Is your time worth more than $6 an hour? Then think hard before you sign up to earn that rate. And can you sit still while the market does the heavy lifting? Because that boring ability is worth more than any indicator you'll ever learn. None of this means trading is evil or that nobody should ever do it. A real 1% exists. But you should walk in knowing the base rates, the tax math, and the true hourly wage, instead of the highlight reel. If this showed you something about your money you hadn't done the math on before, subscribe to Desmond Wealth and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. Because the next time someone shows you a screenshot of a great trade, you'll know the only question that matters. Not how much did you make, how much did you keep, and what did it cost you to keep it. Make the decision that matches your reality, not someone else's sales pitch.